Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025. Good evening, welcome to the program. And suddenly mining becomes centre stage again. We'll speak to the Harmony CEO, Beyers in a few moments. We'll hear from Graham McKay as well, the editor at Miningmx. But also, and I do think it's worth just staying with us when we speak to Peter Leon. You know, of course, if you want to know anything about mining law in South Africa, he's the guy. And once again, we seem to be in a situation where I just get that sense that the person who's in charge of mineral resources for the government, and at the moment, of course, Gwede Mantashe, but this has happened time and time before, and the mining industry, very, very upset. At this time, it's of draft changes, amendments to the Minerals and Petroleum Resources Development Act. And again, I don't quite understand why there always has to be such a fight. And the Minerals Council confirming today that, in fact, they were not consulted on these changes, that they really had no input at all. What's the point in sort of talking to the industry if you're not going to actually listen to them? They remind me a little bit of what the legal people said when they've now decided, two of the big firms, I think it's three of the big firms actually, deciding to challenge the new code around equity and essentially BEE. Now, of course, we need transformation, but there are ways to do it. And maybe the industry has some better ideas. At the very least, I mean, just because it's good politics, pretend to listen and include one of their suggestions, but to include none of them makes it almost look, if maybe for political reasons, someone actually is sooking. Someone actually wants a fight. Maybe I'm being too cynical. We are going to try and get hold of the ministry, and the minister, of course, is Gwede Mantashe. I must just tell you, despite trying many times over the last couple of years on The Money Show and in my previous life, unfortunately, that hasn't happened. We will keep trying because, of course, we must keep trying and we must hear from him, or at least an official from the ministry. So that'll be one of the things we'll be chasing tomorrow or even on Thursday if it does take that long. Good to hear from you on that. You might well have a strong view on empowerment and mining. And in some ways, if you consider the role of mining in South Africa over the last sort of 150 years, well, maybe it's no surprise that, in fact, this is something we fight about. It's a bit like land. It's not quite as deep and as old as land as an issue, but certainly is something that we're going to have a lot more politics about. Good to hear from you on that. On 011 883 0702 021 446 0567 and voice notes this evening on 072 702 1702. By the way, we will hear from Liberty a little later in the program, but I was astonished to find there's a massive disparity between the number of men who basically seek a payout from their insurance policies because of retrenchment, and the number of women. The number of women is much higher. I don't understand why that would be. Something clearly is going on. We'll find out more about those numbers in the show as well tonight.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Harmony Gold announcing today it wants to buy the Australian company MAC Copper. It operates the CSA copper mine in New South Wales. It produces over 40,000 tonnes of copper a year. Copper prices rising through the year as a result of higher expected industrial demand, partially linked to AI and automation. At the same time, as you know, some gold miners have found themselves making very high profits because of the incredible gold price at the moment. Beyers is the CEO at Harmony. Beyers, good evening. 18 billion rand is what this will cost. I presume you see a lot of value in MAC Copper. What does it bring to Harmony Gold?
Indeed, Stephen. Good evening, and good evening to your listeners. And yes, we're very excited about the announcement today of acquiring 100% of the shares in MAC Copper via a limited Jersey scheme of arrangements. We have a unique skill set in Harmony, mining the deepest mines in the world. And this is a relatively deep mine in Australia, mining copper. And we feel that Harmony's expertise and our ability to extract extra value, like we've proven over our 75 years of existence in acquiring mines from other owners and recapitalizing them, turning them into added value And this is one examples where we see a lot of additional value under Harmony management.
Do you believe you'll be able to maybe keep the mine going for longer than other people might because of this experience?
I mean, that is the Harmony model, and we've got a proven record of doing that, Stephen. And, we've done that, as I said, for basically 75 years. The company is almost 75 years old. And, in the last few years, we've acquired the remaining AngloGold Ashanti assets in South Africa and have extended the life of those assets, being the partner of choice in the areas that we operate. So, we look forward to do the same in the Cobar region with the people of Cobar and the communities around the mines. And we undoubtedly, see a lot of upside potential. I mean, this mine is a mature mine. It's been around for a long time, and it's got an excellent resource-to-reserve conversion over the years. And, we believe that there's more to come. And in particular, in an area called the Merrin mine, which is a shallower part of the ore body that we believe will provide further growth going forward.
It's a premium of 20% on the share price as it was on Friday. Do you believe you'll actually be able to convince the current shareholders to go for the deal? You've got some of them already, of course.
Yes, indeed. It's a 20% premium, as you said, on the spot price on the New York Stock Exchange in the close on Friday. And as you know, one needs to have 75% of the shareholder vote when the shareholders do vote. I mean, talking about the MAC shareholders here, when the circular is out. Part of what we included in the conditions of the deal was to get at least 20% of the shareholders to commit up front. And, I'm happy to report that we've gotten that and more. And obviously the board of MAC have also recommended to vote in favour. So, yes, we think we're out of the blocks with this one, but, there's still a way to go to close the transaction. We're confident, with a funding plan in place, and the amount of work we've done on the due diligence and the understanding, Stephen, we created on, the mine and the bottlenecks and the opportunities, we think we're well positioned, with MAC to close the deal.
We do see predictions of stronger demand for copper in the near future, with a high gold price, perhaps that's giving you some of the resources to do it. Are you looking at any other targets at the moment, Beyers?
We're always looking for value and value-accretive targets, but, I must say, this is, we've got our plate full at the moment. This will keep us busy, and indeed, M&A in gold is tricky at the moment. Gold prices are at, highs that, that humanity has never seen, and that obviously filters through to mine valuations as well. Copper, on the other hand, is an area in the M&A space where, that's not quite the case on the copper price. So, we're trying to get in early on copper, and this was an ideal opportunity for us to do so. Further to this, we've got Eva Copper, which is an ore body we own, Stephen, and that's an ore body where we're hoping to come to market with the outcome of the feasibility study on building the mine. So that'll be a greenfields mine that we have to build. So first this, then Eva Copper, which is an ore body we own, and then after that Wafi-Golpu, which is the tier 1 copper gold porphyry we own in a 50% JV with Newcrest. So exciting times to come, international diversification for Harmony, as well as commodity mix diversification with copper coming in.
I'm sure you've been watching the latest around the Mineral and Petroleum Resources Development Amendment Bill. The Minerals Council has said, and I know they represent your industry, has said that they believe they were not properly consulted on this. Their inputs were ignored. Are you frustrated by what I think is probably going to be another big fight between your industry and the ministry?
Yeah, Stephen, I don't wish to comment on that. We've had an exciting day on announcing this transaction, but, we firmly align with the view of the Minerals Council, and we participate and air our views actively there and participate in terms of, thought leadership there. So, we are part of the process and, part of the position that the Mineral Council has taken on this.
Beyers Nel, thank you very much indeed. The CEO at Harmony. Listening to that, David McKay, editor at Miningmx. And David, let me just start with that. You've been leading some of the reporting on this as usual. It does seem to me that, again, the government and the mining industry are not getting on with each other. And how many times have we had this happen in the past?
I'm losing count, to be absolutely honest. It's really disappointing, I've got to say. When you consider that South Africa has a window of opportunity right now to improve its investment, sort of prospects, if you like, and that's because within Africa generally there's a lot of heightened political risk in West Africa. It always attracts a lot of dollars, whereas whatever you might think of the GNU, it's still there and stable. Our infrastructure is good, and we've got resources, and we're introducing a new cadastre which promises to improve transparency on mineral right applications and prospecting rights. You put all that together and you think, well, that's a really good recipe for upping our profile and attracting more dollars to South Africa. And now we come along and we do exactly what we've done in the past and shoot ourselves in the foot and introduce quite a lot of uncertainty into very important issues like security of tenure. So there we have it. This is, though, a draft document. Public comments it's always an important process. There's 2.5 months to go through it, quite a lot of time. So let's see if we can find a middle ground.
The Harmony deal, a 20% premium on the share price for Mac Copper. A good deal for Harmony. It does seem there's a lot of interest in copper at the moment.
Yeah, I think this is a really nice deal for Harmony. And when they bring as Beyers was saying, when they bring the copper project Eva online, there will be 100,000 tons of copper in Australia. It's really good diversification. Good use of cash. I mean, there's two ways to look at it. I mean, Harmony's producing a lot of cash at the moment, obviously because of the gold price. They could pay it out to shareholders. They've taken a more conservative approach, which is pretty much how they profile in the market. And they've said, no, we'd rather diversify our risk by investing in its existing gold mines and building, projects elsewhere, and building cash flow from outside of South Africa in a commodity where the prospects are really good.
And then, obviously, I mean, we've heard commentary in the past before about how when the gold price is very high, or any commodity really, we get to a sort of deal-making phase. It did make me wonder if we were there again.
Oh, yeah. This is all the rage at the moment, I mean, it's this particular deal that Harmony has done is quite a smart one. I mean, the mine it's an old mine, this, by the way. This is not it's a cash generator, but it's been around for a long time, and it's quite deep by Australian standards. So it's kind of perfect for Harmony because that's what they do here. They buy aged assets and they find ways to breathe new life into them, and they renew the resources. So I think it really horses for courses with M&A. Some's good, some's bad. I think this one for Harmony kind of really suits the skill set within the company. So it's a really nice deal, I think. One quick thing. I mean, they talk of the deal being, what do they say? I think it's about $1 billion. It actually increases to $1.3 billion because there's debt in the company that they have to take on as well. It's worth pointing it out.
David McKay, thanks very much indeed. Editor at Miningmx, you with The Money Show, 21 minutes after 6 the time. Well, let's get another view on these draft changes to the Minerals and Petroleum Resources Development Act, which the Minerals Council is so unhappy about. Peter Leon's a mining expert and partner at Herbert Smith Freehills. Peter, good evening. Good to talk to you again on The Money Show. Is this bill, or these drafts rather, going to make it much harder to mine in South Africa?
Almost certainly, Stephen. The amendments are, I mean, they're only a draft, and there'll be a public comment period which expires at the middle of August. So there's 2.5 months to take comments on board. So it's not the final deal, but I think the bill is regressive, doesn't really address the issues that the industry has, whether it's around logistics, time limits for decisions, black empowerment, regulatory uncertainty, all the things that the Minerals Council and others, people like me, have been talking about for the last 10 years, simply not in this legislation, which has taken some time to produce. And frankly, it's a huge disappointment what's been produced by the department.
As I understand it, one of the issues is that people who want just a prospecting right, so you apply for the right to look to see if there's enough of a particular mineral in a particular place for it to be mined economically, they would also have to be empowered. This is something the Minerals Council seems very upset about. You would, I suppose, essentially be giving someone a stake in something that may have no value at the end.
Yeah, and the other thing is also it's prospective, so it's very uncertain. And it's capital intensive, costs quite a lot of money. You're basically giving away 30%. And that's the first point on the economics. But the second point is that this minister, Gwede Mantashe, when he became the minister, said that prospecting rights would never need to be empowered. And even under the Act, as it was originally drafted in 2002, the issue of empowerment for prospecting rights was always discretionary. And the last version of the Mining Charter doesn't really appear there at all. So this is definitely a step backwards, and I can understand the Minerals Council's concern.
I don't know if this is a negotiating position. I mean, do you see any evidence that a lot of thought has been put into the actual consequences of this?
No, I think very little. I mean, the problem is that, it seems to me that, these are very, very extensive amendments to the Act. So one would normally assume some sort of policy document or, green or white paper would precede it. None of that's happened here. These have just been bolted on to the legislation and making a difficult situation worse. The other thing, Stephen, is that there'll now be a requirement for ministerial consent for any change of control in an unlisted company and in a listed company. So it effectively gives the minister extraterritorial powers and the ability effectively to interfere in offshore securities exchange transactions, which is unheard of in the mining industry, quite frankly.
It does seem astonishing. If the industry's inputs have not been included, could that mean legally that there was no proper consultation? And in other words, could that mean just on that basis that in fact this whole process could have to start again? I mean, there are, as I understand it, constitutional court definitions of meaningful consultation. We are still at the early days of this, but presumably the ministry would have to show some flexibility.
No, they would have to, but actually the cases you're referring to, which really deal with the parliamentary process, there's a very clear obligation on Parliament to consult all interested and affected parties. So, but that stage hasn't started yet. This is simply a consultation draft circulated for public comment. So the second stage is once the bill is revised and introduced to Parliament, then the department will have to be very careful, and Parliament will have to be very careful that they consult all interested and affected parties. But can I make a slightly different point? The other thing that's been a major issue for the industry over the last number of years is the issue of beneficiation. Because there, you might remember, the bill that was introduced in 2013 was ultimately withdrawn and lapsed, because there the department introduced effectively quantitative restrictions on exports by mining companies. Now, that hasn't come back in this version of the bill. What it does do is says that mining companies or mineral producers must provide minerals for beneficiation, for local beneficiation, on an unspecified, unquantified, and entirely discretionary basis. So I think through the back door, the department's basically scored another earned goal there as well.
Sure. Peter Leon, thanks very much indeed. Mining expert and partner at Herbert Smith Freehills.
The Money Show.
The markets.
Marco Eftafio is the lead specialist for investment and trading sales at ABSA CIB. Marco, good evening. Thanks for coming in tonight. Harmony Gold, their acquisition of Mac Copper, does seem, from what we've heard already, quite a positive deal for them.
Evening, Stephen. Yes, it does seem so. I think the market didn't take it that well. I think generally investors out there hoping for a little bit of capital return rather than a big acquisition. And I mean, this is not a small one at 1.3 billion overall price. But, that said, 7 times EV to EBITDA, not an excessive multiple for a copper asset of this quality, that's for sure. As the CEO said, ticks a lot of their boxes for their strategy. So I think that's positive. And immediate copper production as well as cash flow, clearly does de-risk the deal to some extent.
It would seem that we're going to see quite a few more deals like this. We're in that sort of phase of the market because of the gold price. Absolutely, Stephen. When we see gold companies producing a lot of cash, there are always assets out there to buy. And I think, this deal probably a little bit better than potentially some of the others, with the copper being bought rather than gold mines at very high multiples elsewhere in the world, particularly in Australia. Results from Pepkor, quite positive results. I mean, some of the numbers are astonishing. Something like, I think it's 8 of every 10 prepaid cell phones is now sold through Pepkor. It does seem to be very much have a lot of momentum behind it.
Absolutely, Stephen. I mean, we saw HEPS coming in 19% growth for the year. That's well above the midpoint of guidance. You continue to see them, grow very well, as you said. But the key standout areas for me, fintech up 35%, financial services up 67%. Really nice to see that coming through.
And I mean, one wonders if it's going to have sort of other impacts on other retailers, because what must be happening to them must tell us something about the environment that they're all trading in.
Absolutely, Stephen. I think very interestingly, winter weather coming on time this year, hitting us in May as opposed to last year where it came much later in June. Very positive for full price sales on winter wear. And we actually saw both Truist and Foschini up over 1% on the day on that positive read through.
And then Bidcorp, they had a capital market update.
Yes, they did. So it's top performer on the top 40 today, up 1.7%. Very nice guidance there, saying trading profit up about 10% in constant currency. And that's in a zero inflationary environment. I think the market was somewhat concerned leading into this that the UK could be tough, but UK doing really well. Amazingly, Europe printing plus 10% on revenue. The only drag in them is really the Australasia region, where the consumer's under quite a lot of pressure.
Marco Stathio, thanks very much indeed. Lead specialist, investment and trading sales at ABSA's CIB. Just to sort of pick up on the comments around Pepkor and how interesting those results are and how big that they've become. I mean, I was astonished to see that 3/4 of all school apparel. So if you see any item to do with something that a child would wear at school, 3/4 of that is going through just one company. And it does tell you something. It tells you about distribution, tells you about price, I'm absolutely certain. It tells you about the impact that it's having on society as well. And also when you consider what it is, which is textiles, which is clothes, the sheer volume of it is absolutely massive. Clearly something is going right there. We had hoped at some point to hear from Pepkor themselves. We'll keep knocking on their door and, hitting their phone lines and all the rest to see if they'll speak to us on the Money Show about some results that do show that they do seem to be doing very, very well indeed. Don't forget, in the next half hour, we'll hear why it is that more women, appear to be applying for payouts from retrenchment insurance than men. Something very strange going on in the market. You're with the Money Show. Good evening. It's 6:30.
Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
Well, you might have seen the report by Amabungani, the Amabungani Centre for Investigative Journalism today, published in various outlets, making the point that Petro SA, it appears, is trading incredibly recklessly at the moment and actually spending, large amounts of money. This is the oil business we're talking about here. Spending large amounts of money buying oil it could not store. As a result, it had to sell it at a loss because the price of storing it was simply just too expensive. It would actually have to use tankers to store it. In other words, ships. And you would have to pay all sorts of fees to do that. And again, there have been requests from Amabungani for more information on this. It seems that, again, the minister, and I don't really mean to pick on him tonight, but these two things have happened coincidentally. But it does seem that he's refused to answer questions. In fact, he sort of said in a press conference in response to a question, if I give you this information, it'll be the end of Petro SA, which reminded me about how opaque the oil industry is. And it seems to me oil always has been. I'm never entirely sure why, but it does seem that for many, many years, you don't really know what's going on, where the oil comes from. There are people, of course, who do. But it did strike me that in terms of industries, oil is incredibly opaque. But it's your money that's going down the drain, by the way. If something goes wrong with Petro SA and we have to bail it out, and could we really have to bail out another SOE? Surely not. Well then, where's that money going to come from? I'll give you a hint. You can look in your rearview mirror right now and you'll see the person.
702. Stephen is on X.
At Stephen Grootes.
The multinational technology group DataTech reporting an increase of 37% in their operating profits to $69 million today, despite revenue being down by nearly 9%. The company owns several different technology companies across the US, Latin America, the Middle East, Asia, and Africa. Jens Montanana is the CEO at DataTech. Jens, good evening, and thanks for your time. Your revenue was down, and yet your profit was up. Was that just some changes to accounting, or did you make a more fundamental change in the business?
Good evening. No, nothing fundamental. In fact, the secular forces in our industry are very favourable at the moment and expect to continue so. The revenue line is a little bit misleading and needs also a little bit of explaining. We have modified our IFRS revenue line to basically take account of a shift that's happening in the industry, which is software is increasingly what's called net accounted. So we don't recognise the sales value of the software. We recognise the gross profit that we make. So when you make that adjustment, it has the impact, of course, of reducing your revenues and improving your margins. But that's just optics, and you have to really follow the gross profit dollars that we bring in, and they rose by about 9 or 10% in that period that you referred to, and that resulted in a big jump in our operating profit, obviously because we've got good leverage down the income statement.
Okay, that makes a lot of sense. Thank you. You talk about the secular forces that are at your back, a following wind, if you like. Are you seeing the same kind of forces, the same kind of demand for your services across all of your different regions? Is there a sort of, do they all move together consistently?
Yeah, pretty much. I mean, obviously you've got the macro, which all companies are exposed to, but most businesses, organisations in our space, in terms of IT services and technology supply, have this year reported similarly, and good results and similar dynamics. And the dynamics are the rise of AI now is starting to impact what companies and enterprises have to prepare for. So that's basically infrastructure refresh and upgrade. Think of your whole IT real estate needing to basically catch up with what's going to be required. That's one. There's a lot of impetus there, and of course that's driving two areas which the Datatech Group is very focused on and always has been, and that's networking, which is the networks themselves, and increasingly cybersecurity now, which is about 40 is close to 50% of our business. And of course all of this upgrade in processing power, machine learning, AI, advanced technologies, hitting most companies is, of course, massively increasing the threat landscape, and that's one area of our business that we've seen, on the rise, pretty much the last 5 years, and it went up. It went to a new level, after COVID with hybrid working and online and the rest of it, and it's never really come down.
I don't know if cybersecurity demands for it and the cost of it will ever come down, simply because there are so many threats now, and the threat environment, if I can call it that, is moving so quickly, partly because of AI. I mean, it's very bad for society, but for companies that provide security from that, I mean, it's an almost inexhaustible source of demand.
Yes, absolutely. I mean, obviously, they're like all areas of technology. There are areas, even within cybersecurity, which standardise and commoditise and so on. And then, of course, you've got other areas that are on the rise. So, but I mean, we've been at this for, more than 30 years. So, innovation, I mean, we like innovation, we like disruptive technologies, and we're in an environment at the moment where it doesn't look like that's going to slow down at all anytime soon.
It does mean, though, that I suppose you will have to spend quite a lot of money and quite a lot of time and energy on making sure you don't fall behind in any way. You'll need to innovate yourself, as I'm sure you do. Do you then have to spend quite a lot of money doing that? And, when I hear you talk about how companies have to basically sort of almost re-spend, basically make bigger investments because of AI and things like that. I mean, not every company is going to be able to do that. It's also moving so quickly that just to keep up, just to stand still means you need to run really fast.
Yeah, I mean, I think we're fortunate. I mean, obviously we've had, like most tech companies, we've had bumps along the way, but I think we're fortunate that we operate in so many countries, and we've got over 10,000, I think close to 11,000 employees, that as companies need to move forward, we have to retool as well. And I mean retool at a human capital level. But I think we're fortunate, like bigger companies in the tech space, that we have a deep pool of skills. We've got good domain experience in the main areas that we operate in, and we will reach out and do M&A, generally small to mid-size M&A, where we need to get skills faster in terms of, let's call it the human arms race, and we need to, get to market quickly. And then we also, of course, invest heavily as a continual thing with the adapting of our own resources and cross-training and the like. But, we tend to represent, large technology manufacturers. They have a lot of accreditation and certification programs, and I imagine 35% of the people we employ, 35 to 40%, are technical people, and technical people like doing new things.
That you talk about skills. Are skills becoming scarcer? Or are you finding that actually because AI depending on what you read, may be taking some jobs, may not be, depending, again, if you read something else, that actually there are more IT people around who are looking for a job?
Yeah, this is a very interesting question. The impact of, you could go back, 20 years now and say, what's the impact of the internet in general on many professional industries? It's quite hard to unwrap all that. I think what is clear is that we're in an environment at the moment where there's most probably less job migration at the moment than there was certainly coming out of the COVID years. The equilibrium in terms of supply and demand of technical resources is more balanced. It went through a period where it was undersupply to oversupply, and I think we're in an okay space right now. We haven't seen that much wage inflation, and we think, and you might be right, AI and of course the technologies that we sell ourselves in many areas are, they're deflationary for our customers. So of course that keeps wages in check, and and it happens to our own industry as well. Let's call it the technical resource balance.
It's fascinating. I think there's a conversation that everyone's having in some way or another. Jens Montanana, I really appreciate the time. Thank you. CEO at DataTech.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Well, good to hear from you tonight on 011-883-0702 and 021-446-0567. Some interesting numbers out today from Liberty about who's getting paid out for certain situations and why when it comes to life insurance products. So the company saying the amount of money paid to people using its life protection products increased by nearly 20%. Lifestyle protection payouts increased by over 20%. Andrew Methman is the Chief Specialist for Risk Pricing at Liberty Group SA. Andrew, good evening. There's a big increase in the amount of money being paid out for lifestyle protection. Why are so many people, it seems, losing their incomes?
Thank you, Stefan. Thank you for the chance to speak about a very important topic. I think just to position it, we've got various benefits that we do offer through various channels. But if you think about the comprehensive risk product, the lifestyle protector product that you are referring to, those are for a variety of reasons. Yes, there are certain economic reasons, but by far the biggest reason that we found is unfortunately death. But then there's also different things like critical illnesses and disability that we do protect against. And I think those are the ones that we are seeing big increases in. Yes, we saw a big increase in claims across the board, but specifically for what we call the living benefits, we have seen a noticeable increase in those. And I think I think Liberty is very proud to be able to offer this risk protection to these clients at these times of need that they have. And I think this does prove that the key thing that we want to do is instill trust that we're actually there for them when it matters most.
Okay. Are there specific things? Are there specific diagnoses? Are there specific, is there a rash of specific accidents maybe that's leading to this?
Nothing that's different to previous years. Key one is obviously cancer. That goes through all our benefits, both our life cover and our living benefits. And then you've got quite a few other ones that do come up in the second and third place. There's obviously cardiac and various other things that have caused lifestyle and other disruptions to clients.
There's quite a sort of strange, a very significant disparity in your numbers around retrenchments and the differences between men and women. And it looks like far more women have to use their retrenchment insurance than men. It's a big difference. Why do you think that's happening?
Yes, look, it's hard to speculate why that is. we've looking at our numbers, that is what has come through. We have looked at the actual numbers that in terms of women do tend to take the living benefits more, and especially the retrenchment benefit too. So that explains partly, but they are still claiming more than men, even when you adjust for that. So that is something that we did pick up, and we do need to look into it further. But it does show the overall kind of the uncertainty in the economy. At a top level, we did find that the retrenchment claims did come down from 2023 to 2024. But I think we must note, the 2025 is quite a volatile year. Quite a few things, extraordinary things, tariff wars, aid being cut to certain organisations, and I don't think we've yet felt that coming through in all the second order effects. And I think we need to monitor that. It does take a while to filter through to different parts. Obviously, if certain income is not coming into the country for whatever reason, that will end up in terms of job losses and downstream income to other companies. So something that we are concerned about and looking at.
This would just be a guess, and I have no numbers to back this up, or certainly none in front of me. But I would suspect that the higher you are in an organization, you're probably less likely to be retrenched. And that would mean that maybe it's sort of mid-tier people who are more likely to lose their jobs. And I wonder if that might be part of the explanation. We've known for a very long time that women are not as able to progress through their careers as quickly as men. I should say most women and most men, in fact, partly because of what happens when they have children, and that does seem to end up affecting their careers dramatically.
Yeah, it would be hard for me to speculate on things like that. Like I said, I think we do need to give a bit more of a deeper dive into it and see. But I think we have noticed that overall women are, if you look at the ASISA insurance gap study from 2022, they are largely underinsured by about, I think it was 15 trillion or so, a very staggering number, and especially the younger women. So I think the key thing to point out is that I think we do encourage them to look at their risk protection needs and just reevaluate, are they fully covered, and making sure that they know what risks they need to cover.
Andrew Methman, thanks very much indeed. Chief Specialist Risk Pricing at Liberty Group SA. If you have any other thoughts, maybe you have some experience on why it is that women seem to be more vulnerable to retrenchment, certainly on these figures, and it is just one set of data. But if that is the case, it'd be good to hear from you tonight on 011 8830702 021 446 0567. You're with The Money Show at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025. We will look more at the green economy in the next little while. And it does seem to me that the wind has been blowing kind of against the green economy in the last little while. Some of that wind's been coming from Washington. Some of it also coming from London in the form of Tony Blair, the former British Prime Minister. In the UK, they talk about net zero. They try and set certain targets for that, a bit more ambitious than we are, and for various reasons. You can understand why. And he says that actually that's not achievable. So it's not just the people you would kind of expect. And I'm reminded, I think sometimes he would prefer us to forget it, but Mark Carney, the current Prime Minister of Canada, who was really able to score an extraordinary sort of political comeback for his political party, partly because of what was happening south of Niagara Falls, by which I mean Trump. He made his name actually in climate financing long before he was the governor of the Bank of England, or the governor of the Bank of Canada, I think it's called that, long before he came to prominence. That was his claim to fame. People who would have known him only for ice hockey at the time, but that's what he was doing. That's really where his sort of quite incredible brain was first put into action. So interesting just to see how that ebbs and flows a little bit. We'll hear from Rotendo as well, of course, Dr. Rotendo Hundwingi, talking about updating us on what's happening on our continent. And don't forget Warren Ingram as well this evening, why we should mix shares and bonds in your investments. Looking forward to that conversation as well.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
This week, The Money Show will be coming to you live from the stunning 5-star Beverly Hills Hotel in Umhlanga Rocks as we overlook the warm, beautiful Indian Ocean of KwaZulu-Natal. The special broadcast is brought to you by Prime Media Cares and marks the exciting launch of Corporates That Care, KZN. You may already know Corporates That Care from Bongani Bingwa's show every Wednesday at 10 to 9, where we shine a light on the amazing work South African companies are doing to uplift communities through their CSI and social impact programs. We get to know the inspiring leaders behind these initiatives, the people who believe in building a better tomorrow and who understand the power of real change. Now, Prime Media Cares and 702 are focusing their spotlight on KwaZulu-Natal, celebrating the corporates who are walking the talk and making a difference in this vibrant province. It's all part of our mission to inspire, connect and honour those who are working for a better South Africa, one project, one person, one community at a time. So tune in for a powerful edition of The Money Show, live tomorrow from Beverly Hills Hotel in Umhlanga Rocks.
702. Stephen is on The Money Show.
6 to 8 p.m.
Green economy is, well, over the last few months, it's looked a little like the drive towards a greener economy and the use of more renewable energy does seem to have had, well, some headwinds, let me call it that. The Trump administration very against the change. I mentioned Tony Blair a little earlier. He's saying that Britain's being too ambitious. The political balance may be shifting in some way. Let's speak to the energy and financing expert, Jose Moleshe. Now, Jose, good evening. I mean, one of the arguments people have been using against the transition to a more renewable economy is that it will cut jobs. From what we've seen up until now, what actually happens with jobs when we start to make this transition?
Good evening, Stephen. Yes, what happens to jobs, it depends on which sector it is. For instance, during construction for renewable energy projects, you have significant employment opportunities, and then it's relatively lower when it comes to the operations and maintenance. But then there's again recycling where you have significant job opportunities. So it depends really in the sector, which sector in the green economy you're looking at, that jobs are. Also, I think from the green economy point of view, the countries that seem to be involved in significant manufacturing capacity, like your China and other countries, tend to have significantly more job opportunities in that regard relative to those who just import equipment.
I mean, it's interesting to see how it is changing. I mean, the other issue that comes up all the time is people talk about this. They say that the amount of energy you have, you'll actually be less energy secure. You can't control the wind. You can't control cloud cover and solar energy. We hear, by the way, often people are saying, no, well, you must stay with nuclear. You should stay with coal. People use the phrase baseload all the time. I mean, is all of that true? I mean, some parts of the world seem to be getting along pretty well with renewable energy?
Well, in my view, Stephen, there should be a balance. And there are three things that need to be in balance. One, looking at environmental concerns, and that includes integrating renewable energy sources. But as you correctly point out, they are variable, so they can't function on their own. That therefore means that to have secure energy, you need a total mix of different technologies. Some that are flexible, like gas, comes in when renewable energy are not really available due to weather, and other nuclear, for instance, is similar to renewable energy in terms of being clean with no emissions, and it provides baseload capacity. So anybody who calls for one type of technology is going to create a problem. In countries like Europe, you have integrated countries where if one of the countries has got challenges like Germany or Spain, they rely on the others that use anything from nuclear, gas, and all sorts of different technologies to support each other. So it's an integrated system, whereas South Africa is bigger than most of the region, and therefore when we have challenges, it's going to be difficult, even if we're integrated, to be able to rely on our neighbors. So each country has to consider these things in balance.
I mean, obviously, the way in which we do that gets better and better, right? We get more and more used to it.
We get more and more used to it, but we have to be cognizant of the fact that when we integrate variable renewable energy projects, we can only go to a certain extent before we then create challenges. So as long as we have that, as you correctly point out, learning from others, seeing what lessons are learned from that. For instance, renewable energy cannot supply industrial processes like glass making and those kind of things. So you do need things like gas to be able to help you with heating and all other sort of. So we need to look at energy in an integrated fashion.
We spoke to the chair of Nedbank, Daniel Manele, yesterday. You know the role he's played in our society, of course, and he was talking about how important it is to change the global financial architecture to finance this sort of climate transition. We know also that, the Americans have pulled so much money out of this globally, and of course, I imagine China just continues on the path that China's decided to take. But does that mean that there's a lot less money around for these projects?
There is significant money available for green financing. In fact, in the past, there's been a challenge financing more of the fossil fuels. But as you correctly point out, countries like the U.S. are now saying that they need to finance fossil fuels as well. So there is significant finance available for green energy. There's no shortage. It's just a question of projects being available. If you look at the U.S., though, just to discuss the issue that you mentioned, the U.S. used to be a net importer of fossil fuels, and they developed their gas using fracking, by the way. They are now a net exporter to Europe, where there's problems with gas from Russia, and they are gaining significant money from that. So Trump is looking at the economic aspect as well as energy security, not just the green element, which is why I call for a balance. That balance should also include equity. Africa has about 600 million of people who are not electrified, and that needs to be a priority as well. And you need significant resources in the energy sector, diversified, to be able to address those challenges.
Jose Moleshe, thanks very much indeed. Really do appreciate the time. The energy and finance expert talking to us this evening.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
Time to find out what's happening in our continent now. Dr. Rutindo Hundwengwi, the founding director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. Rutindo, good to see you tonight. The EU ramping up its economic footprint in Africa. There's a big investment, and there's obviously a big contest in Africa at the moment. I mean, we heard yesterday about how it was interesting to me, the US, the UK, and China are the nations with the biggest brands in Africa.
Very true. And good evening to you, Stephen, and good evening to your listeners. So definitely the EU wanting to position itself from not being a donor, but more to an investor. And they've got a vehicle called the Global Gateway Initiative. And one of the key projects that they've just invested in is a $40 million link. I think it's actually a bridge called Langshore Bridge between Chad, Jamena and Douala Port in Cameroon. And the reason for this is obviously they want to upgrade that corridor so that it increases trade, reduces trade costs, increases efficiency, strengthens EU partnerships. And like you said, Stephen, traditionally China, the USA, and Europe are sort of the leading brands with regards to investment in Africa. But when it comes to infrastructure, we've seen the Middle East also coming to the party. But at the end of the day, this funding for the Douala-Jamena corridor is structured under a guarantee mechanism developed by the EU and IFC. So it's a positive progress with regards to positioning Africa as being an investment destination as opposed to a donor destination. A combination of innovative and blended finance is the structure of the frameworks of the funding, but ultimately it's infrastructure that Africa needs. And bearing in mind that annually we are short by about $100 billion of financing for infrastructure. So anything along those lines with the bigger picture of AfCFTA is always appreciated, Stephen.
I mean, it is a way to increase your influence to do deals like this. You get sort of tied to the country that does the deal. I mean, we all know that. We've all borrowed money from banks.
Yeah, I mean, at the end of the day, you can choose your friends, but you can't choose your relatives. And I guess the relatives you create when it comes to money, it applies the same. But 100%, Stephen. But at the end of the day, if you look at us, we're 3% of global GDP as a continent. And the challenge of that is that we never have enough wealth in the continent with regards to solving the problems we have or the demands of solutions that we need to address. And in this case, infrastructure. So you have to partner with somebody. The question is, with lessons learned from the past, how do you partner in such a way that you strangle yourself with debt and finance? And that's always the challenge, Stephen.
Yeah, I mean, you always have that in the back of your head, don't you? AGF and Equity Bank, they're unlocking R1 billion in SME financing.
Yeah, and this is through the African Guarantee Fund, which is a pan-African financier. They've partnered up with Equity, one of the leading Kenyan banks. And the purpose of this is Equity wants to support SMEs in Kenya, Uganda, Rwanda, and Tanzania, and DRC. And that by this kind of investment, the investment, Stephen, is around plus or minus $500 million US, but to unlock $1 billion and 50,000 jobs. So definitely target for the SMEs. I think what's interesting, Steve, is when you look at the stats around the SMEs, for Africa, for example, people take it for granted, but 19% of the world's, we have 19% of the world's population, but only 3% of global GDP. But over and above that, 60% of SMEs in Africa contribute to over 70% of new jobs. So we've got a large level of SMEs that potentially can be scaled up, but the problem is that there's not enough funding to scale them, to take them to the next level. Looking at the stats again, Stephen, it's estimated there are about 44 million SMEs and MSMEs on the continent. So we've got all this potential of SMEs and micro SMEs. The challenge we have, Stephen, is there's not enough funding to get these guys to scale up. And it's not just funding, it's also the ecosystem around that. So that's the biggest challenge, a lot of opportunity. And key sectors, agriculture, because the leverage of the land and the climate we have. So this initiative by AGF and Equity in terms of stimulating the SME base and allowing it to grow will make significant inroads, but still it's a scratch in or a chink in the armor with regards to the bigger picture. So a great opportunity, but also it also highlights the great vacuum of lack of financing and scalability of SMEs.
And Nigeria cracking down on Facebook over tax and data violations. And I mean, this always gets very, very exciting when this happens.
Yeah, and this is a familiar story, Stephen. I think, remember, South Africa had a similar challenge with MTN in Nigeria, and that the implications around that. But we were saying in Africa, Stephen, that the advantage of Africa, and we've seen it with Pesa, we've seen it with other fintech solutions or technology or innovative technology solutions. I think Ziplink, I'm calling it Ziplink, but the one that was with blood transfusion and drones. But we've got the saying that innovation in Africa precedes legislation regulation. And the idea was that, we're able to be innovative and then the legislation follows through. And in first world countries, it's the reverse. And this is, I think it's now catching up to us. And the challenge is that Facebook, obviously an active player in West Africa, is suing or is taken. It's been taken to court by the Nigerian government with regards to data and competition law violations or applied data competition law and violations to the tune of $290 million US. And it's a genuine call for fair taxation, data protection, local content promotion in the digital economy. And it seems like Kenya and Uganda and Zambia are also going the same route. If you look at both sides of the story, everybody's got a valid ground to stand on. Facebook, in terms of we invested, you're telling us now, and on the other side, the guys are saying from a government perspective, we're beginning to learn and be familiar in terms of this environment, and it was Texas. So it's a double-edged sword, and hopefully there'll be some sort of negotiation. But ultimately, Facebook is threatening to pull out, which will make significant impact across the sector, from SME right to corporate, if it does happen. So it's a story to watch and track, Stephen.
And I mean, it's interesting to see how these things play out, because there's always a sense of sort of nationalism. And I mean, as a South African, when things happen to MTN in Nigeria, you can kind of feel it a little bit. I mean, you shouldn't, I suppose. But I do think, and I mean, as soon as politics gets involved, it gets a bit messy.
It gets messy, and I think the challenge with the digital economy, the lines of taxation are very different from those with regards to the in terms of customs and excise at the physical border post. And we've seen how Temu and Shemu have made inroads in Africa because there's loopholes around that. So one man's meat is another man's poison. But in all honesty, $290 million on the P&L of Facebook is not a lot, but the perception from an investor confidence perspective and the precedence it creates, that's where the challenge is. So let's see how it plays out. Hopefully, as I said, it aligns to something that is a win-win for both, as opposed to a punishment for one or the other.
And then the business process outsourcing market. Africa wants to crack that. It's $300 billion, and it doesn't matter where you are in the world anymore.
Yeah, and I think with the BPO market, Africa has actually been attracting a lot of investment in this space. We're still a drop in the option. I think our market size, according to stats, is probably about $8 billion. So from the 300 billion global amount, it's a drop in the ocean. The key countries leading in terms of BPO on the African continent is actually South Africa, which is at about 300 million, followed by Egypt, Morocco, Kenya, and Mauritius. Just to compare, the US itself is at 150 billion. So there's still a lot of potential. But countries like Kenya, for example, has 2 million digital workers employed under the BPO framework. We've had NVIDIA partnering up with Cassava Tech, invest in AI factories. So there's a lot of opportunity for growth and potential. Ghana is getting about $200 million per year for BP projects. And this is because of the resources is applied and leveraging off meters to Africa cable network infrastructure, which coincidentally aligns to Facebook. But it's a market that's definitely growing, Stephen, and making a difference with regards to opportunity and as well as to scaling up. So again, it talks to how digitalization and technology are making an impact on the African continent. And as you're aware, Stephen, one of the big challenges in Africa, we've got skilled resources that always leave the continent. But with Africa becoming a BPO destination, the advantage that is there, Stephen, is now resources, skilled, capable resources are staying in country. They're being involved in technology that is transformative, but at the same time can scale up and take the continent to a different level without people actually physically leaving the country. So for me, it's an all positive thing, and it ultimately makes a huge difference in terms of positive economic impact.
Dr. Rutendo Ndwingi, always good to hear from you. Thanks so much. Founding Director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. Bringing the time on The Money Show to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram's a certified financial planner at Galileo Capital. The subject tonight, mixing shares and bonds in our investments. Warren, good evening. I think it's fair to say that when things are going well in the stock markets, it's quite tempting to keep it all in shares. Tonight, you're going to tell us why not.
Yeah, you're right, Stephen. I think when especially when they've gone well for a while, we tend to start feeling rather clever with ourselves and impressed with how we can make so much money by just letting our stock market investments run. And it becomes an easy game, this investing thing. These runs in the stock markets can carry on for quite some time, sometimes up to 5 or 6 years. And it can lull us into a sense of false security where we think, we're going to get rich, we're going to get to retire quickly. And all of a sudden, one day, the wheel turns and everything stops. And we won't know why that happens. And usually it's not going to be something we can foresee. We wouldn't have been able to foresee, for example, the financial crisis that happened in 2008, the drama that actually unfolded. We might have enjoyed the long stock market ride from 2001 to 2007, and maybe we were a bit worried about share prices being expensive and the like. But the dramatic, almost stop of the stock market and then the fall off the cliff would have caught most people, if not all of us, by surprise. And I think it's important that we know that when we're investing in shares and it's going well, it's very easy to become complacent. And when that happens,
people like me saying, hang on, just be careful, spread your investments across different types of assets. We start to sound like a stuck record, and people think you're kind of old school now and fuddy-duddy, etc., and until the market does take a big hiding. And I think we all saw that firstly in COVID, and then a year and a half later when the interest rates went through the roof and stock markets fell out the bottom. So the answer is we've got to be very careful. We need to be in the stock market. It is the best place to get good capital growth over a long period of time. But if we don't spread the risk, and especially adding in government bonds, we get to a situation where we could see dramatic losses in our money.
Okay, so when markets crash, all sorts of things happen, and we've seen a little bit of evidence of that quite recently. That obviously does terrible things to your investments.
It does. So maybe to give you context, because I think what I've realized is, as human beings, we're not very good at understanding percentages. So let's just say we've done well and we've built up an investment in the stock market of 5 million rand, and we were very happy with life. In a typical market crash, so not an extreme market crash, but a very typical market crash, you would see the stock market lose about a third of its value within the first year of a big crash. So if you've got 5 million invested, that means by the end of 12 months, you're sitting on 3.3 million rand. And for most South Africans, just the loss is more than they'll earn in a very long period of time. So it's not a loss. That size of loss is not something that most people are built to deal with. It's a psychological ability to tolerate risk, and very few people are able to deal with that kind of a size drop. So what happens, and it happens almost en masse, is most people who are entirely invested in the stock market, after a big drop like that, won't stay invested. They won't ride out the storm. They'll actually sell out. And they get to the point where their tolerance for losses and their tolerance for listening to the argument to be patient, etc., gets to breaking point, and they sell. And usually what happens is they transfer the money that was in shares and they put it into cash and hope for some form of interest, just to stop losing money, and maybe that they start to get a little bit of growth on whatever they've got left behind. And unfortunately, it seems we're very good sort of anti-predictors as a market. When investors do this en masse, we tend to make that big switch just before things start to recover. And so the tragedy is that people sell out, and then the market starts to recover. It takes about 2 years for those losses to be erased. And in all that time, the people that sell out are sitting in cash, waiting for things to get better. And the way that they judge that things are getting better is because, you and me, for example, will be talking about the stock market starting to recover, and companies are reporting better profits again, et cetera, et cetera. And by the time that filters through to all the investors that have sold out, they've lost out on all of the recovery of the market, and then might be tempted to go in again. And often they go in just before the next big drop. So it is a vicious cycle when you entirely invest all your money in shares and then don't ride out the very bad times.
Okay, and obviously it's difficult to know exactly what's going to happen. All right then. So when you mix your shares with bonds, how do you actually do it? What changes?
What happens firstly is that the losses get limited severely. So instead of losing, your 5 million going to 3.3 million, if you've got a classic mix of 60% in shares, 40% in bonds, suddenly that drop goes from 5 million to 4 million. And for some reason, psychologically, most of us can tolerate a loss like that. And that's the critical point here is it's about what we can deal with. None of us like losing money, and none of us are going to be very happy when we see our statements. But where is the point where we can actually stay invested and ride out the drop so that we can participate in the recovery again? And it's somewhere around that 20% number for most of us as human beings. And it's not really related to our financial literacy or financial education or even how bright we think we are. It's just the inbuilt psychological tolerance for risk. And for most of us, that's the number. 20% is the drop that we can deal with. So on 5 million, we can tolerate $1 million loss. And so that is really why most of the very big retirement funds and big balanced unit trusts will try and aim for that balance of 60% in shares and then the balance in bonds. The risk management can get a bit better, especially when we start to say, why don't we allocate half of the investment overseas as well, and then in a very similar mix, in 60% shares and 40% bonds. And if we do that, what we find is when the markets, especially globally, have a big crash, the losses are a little bit less severe for us in South Africa, because what happens is the rand acts like a really nice shock absorber. So instead of losing 20%, we end up losing somewhere around 10 to 15%. So even our beloved rand actually does have some benefits for us in a situation like this. So that 60-40, Stephen, is very simple. 60% shares, 40% bonds, ride it out, and then your losses get a lot less. Your recovery might take a little longer, but the point is you actually form the ability to stay invested. And that's really the whole key to this whole business is, how long can you stay invested and let your money generate the money babies that we need to get that compound growth?
How do we end up with the balance of 60-40? Why does it seem that the classic portfolio is 60% of your money in shares and 40% in bonds? I mean, I presume it's classic for a reason.
It is, and it's because it's almost the most the largest amount we can have in shares. So in an ideal world, if we all operated like robots and we didn't have emotions, we would remain 100% in shares all the time and wouldn't be affected by the drops. But because of the psychology of human beings, the 60% is pretty close to the maximum that most of us can tolerate before we get very uncomfortable during a big market crash. And so, I guess it's an iterative process over time. Fund managers and investors have found that this is the point where we can tolerate the losses and still benefit from the growth. So it's almost, if we were building a car, 60% is the size of the engine. That's the biggest engine we can possibly put in the car before the brakes and the suspension and the shock absorbers and the airbags fall apart, and that's the 40%. So bonds, the thing to understand about bonds, especially globally now, is that bonds tend to move in the opposite direction to shares. So when shares are doing very well, bonds are not going to be such a good performer. And then we'll really be unhappy that we've got a bond exposure at all. But when the world falls apart in the stock market, then you see the price of bonds go up. And a rising price is very good for investors. It's the shock absorber that helps at least to limit the losses, or sometimes it actually makes some money. And that's really what we're seeing now on the international markets is bond prices are generally rising because interest rates are generally falling. So even though the stock markets are responding very badly to Trump every time he opens a social media account, the bonds are giving a lot of stability.
Okay, so the bonds give stability. I mean, I keep seeing stories about how bond yields are up, and that surely means that people who are buying bonds are very worried as well. I mean, there's a lot going on at the moment, and shares and bonds are both being affected.
They are. And so when you see a bond yield going up, the math gets a little bit complicated here, because that means that actually the price is falling. And that's because investors, maybe just to talk about America for a second, because it's really in America where we're seeing this happen. And what's happening in the States is investors are getting a little bit worried that America might not be able to service all of its debt. And so they're not buying the new bonds that are being issued by the American government, and so the price is falling, and that causes the interest rates to rise. And the American government desperately wants interest rates to be low because they have to keep paying back all the debt that they've taken on, and so they want the price of bonds to be high and the interest rates to be low. That's not happening right now, and one of the reasons is around the tremendous instability that Trump has brought into the market. Every time he opens his mouth about 50% tariff on Europe, or he attacks the Reserve Bank governor in America, the Federal Reserve governor, he causes instability. And that's actually really bad for bond prices and counterproductive to their whole strategy. But in general, because you can now earn a nice interest rate on bonds, it has become a very nice diversifier away from the stock markets again, which wasn't the case from 2008 all the way until kind of early 2022, when interest rates were pretty much zero and bonds were a terrible place to invest.
Personal finance this evening with Warren Ingram, taking your calls for him as well, as always, on 011 883 0702 and 021 446 0567, particularly on tonight's topic around mixing bonds and shares, how to get the balance right. So taking your calls on that this evening. We do have a question from Carol tonight, Warren. Carol asks, what will happen to the South African stock market if we lose a goer? Will our shares implode? Such a pertinent question at the moment, and it seems to me we should really price in whatever the consequences of a goer are going to be. More from Warren in just a moment.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
The Money Show.
Personal finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. 011 883 0702 and 021 446 0567. Questions from Carol asking, what happens to the South African stock market if we lose a goer? And Warren, I think we should prepare for the worst, frankly, when it comes to a goer and trade with the US.
I agree that the likelihood that the whole of a goer goes south for us is real. I guess the follow-up to that will be what sort of trade deal will we sign with America, and will we get? I don't think we'll get a better deal, but what will be the impact? And when you listen to the economists, it's quite interesting that some of them feel the impact will be totally, or it's already overstated. In other words, people are making it sound a lot worse than it actually will be. And other people, I know Johan Rupert was one of them, saying it would be devastating for the South African economy. And I think this points to how difficult it is when you're making predictions, because no doubt if we lose a go and we don't get a good trade deal, it's bad news for South Africa. It's bad news for the companies that export products to the States. And I guess car manufacturers who export to America will be quite severely affected. However, what we don't know already, and I think that's the point, Stephen, in something like this, is we don't know what's in the price of the shares and the investments in South Africa already. There are fund managers and big pension funds that have the same sets of news that you and I have, and are paying for forecasts and political predictions, etc. And all of that filters back into the price of shares and bonds and other investment instruments that we can buy in South Africa. So, when someone like Carol's asking the question, it's a very valid question. But the follow-up is, if you're looking at this, what you're actually trying to anticipate is, what has everyone else thought about this, and what have they done to the price of investments already? And then what will they do when the news comes out? If the news isn't as bad as they feared, will prices rise, or will the news be worse than everybody feared because they actually were a little bit too optimistic? And I think very quickly you can get yourself into a massive sort of circular analytical process where you actually don't really get a great answer, and so you get more and more confusion. And to me, in a situation like this, we do need to realize a lot of the businesses that trade on the South African Stock Exchange, they don't necessarily sell a huge proportion of their products to the States, but they do sell a lot of their products all around the world. And they're already adapting as fast as they possibly can to the changing environment. They might not all be getting it right, but certainly they're not going to just sit there and do nothing and watch their businesses implode around them if they can find new markets or new ways to trade. So I would be very careful of selling out of the JSE simply because of something like a go. I think a lot of it's in the price already, and I don't think we've got I don't think, almost any good news in the price of shares in South Africa. And all we need is something like the grey listing to be reversed, which might well happen by the end of this year, and a few pieces of good trade news with other continents, forget about just other countries, and we might be in a position where we're better off than we thought. So do I sell out of the whole JSE in anticipation of going away? I don't think so. I think that would actually be a bit of a mistake.
Yeah, I mean, I think a lot's going to happen and a lot's going to change, and I'd be very careful to sort of overreact. And the other thing to remember, of course, is that the whole world's in the sort of same position with the US economy. When we sort of just going back to our bonds and shares scenarios, we talk about a sort of balanced portfolio. When you're looking at the balance between bonds and shares, you say classic portfolio is 60-40 shares bonds. Does it matter how old you are? Does this sort of mixture change depending on where you are in your kind of investment? I nearly said journey. I hate that word. Investment cycle.
It does matter very much. Your age is a huge factor. So when you're in your early 20s and you're at the start of your career, or if you're very lucky and you're even younger than that and you're getting some help from family to invest, then you really should try and go as much as you possibly can into the stock market. So if you can, allocate all of your investments into the local and the global markets and almost just ignore the crashes as they come. And the reason for that is you've got so much time on your side that worrying about a crash when you're 22 and you've got another 30-year career to come or longer, it just doesn't make sense. And you're in the very early stages of your earning and your saving, and so the crashes there are not happening very close to your retirement, and hopefully you can get yourself through the psychological pain of seeing the losses. Actually, what you really should do is if those big crashes happen early on, you should try and save even more into the markets, because you're getting a great price for very good investments at that have just been discounted. But if you're older, especially if you're going to be living off your investments, if you are retired already or about to be retired, that 60-40 split is really helpful, because bonds pay a very nice rate of interest. And so they become a very good source of income when you need an income. And then you get the growth from the stock market to give you that inflation protection. So I think age is a big factor. At the same time, if you're 67, I wouldn't now be reducing my exposure to the stock market below the 60%. Because if you're 67 years old, you might well live, comfortably into your late 80s, early 90s, and you still need the growth of the markets to help you with inflation protection. So aiming for that 60-40 split by the time you get close to retirement, I think is ideal. And then almost all the way through retirement, you maintain that balance for as long as you possibly can, and don't get too tempted to reduce your allocation just because of the volatility. We have to live with volatility now.
Very interesting. Warren Ingram, thank you as always. Certified financial planner at Galileo Capital on personal finance tonight.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Well, U.S. markets on the up tonight, still reacting, I think, to the news from Trump we're talking about trade and tariffs, that he does want to sort of reprieve with the EU, also suggesting that, in fact, they called him. The Dow Jones is up 1.5%, the Nasdaq is up 2.3%, the S&P 500 up 1.9%. So there certainly would be an auspicious signal of what will happen tomorrow. We'll be live with you from Durban tomorrow from the Beverly Hills Hotel with Corporates That Care event. Looking forward to that. And, of course, plenty of money to come. It's just gone 8 o'clock.